Hey guys, what's up? Alec back with the daily stock market, and look at that. Such a green day today. Path with a huge green day. Roblox with a huge green day. We also had Fubo up 10%, Shopify up 10%, PLTR up 10%, and the list goes on and on. So make sure you stay throughout this entire video because we're going to take a little bit more of a deep dive into some of the most popular stocks that have been requested by you guys. First one we'll talk about is Amazon stock because it's one of the most requested, and it's also splitting its stock within like the next month. So get ready. We're also going to go over rumors of when the stock is going to split and some of the positive momentum it could have from a stock split. We also see Amazon close to a 52-week low. Remember, right at $2,000, $2,100 per share was the 52-week low. If you were watching the channel, I was buying heavy at that price point. I think 1900 and below is definitely the sweet spot to be buying like a full share for long-term investors. Right, so here we have an article. It says Amazon stock split, what the chart says ahead of the 20-for-1 split. So Amazon will be right around $100 per share after it splits. Amazon stock is working on its 6th straight daily rally ahead of its 20-for-1 stock split. Here's what the charts say now. Amazon shares have spent most of the year down in the dumps, really the last 2 years. So that's why I think it is such a prime buying time right now, as suffered a peak to trough decline 46% for Amazon. That, however, has not been the case lately. The stock is up 2.5% on Thursday, which is today, and is currently riding a 6-session win streak. Admin the stretch, Amazon has rallied 20% from lows. The move comes ahead of the company's 20-for-1 stock split, which goes in effect on Monday, June 6th. So that's very important. Monday, June 6th. That's next week, Monday. The new stock price, the new share price for Amazon will be around $100 per share, allowing us to do options a lot easier on Amazon and allowing us to own full shares of Amazon. Some have wondered if Amazon is past its prime as the stock split nears, given the way the retail and tech giant shares have performed over the past 2 years. That's a fair question. You know, it's been trading down or sideways over the last 2 years. So now it could definitely coil up and bounce up with the momentum from the stock split. If we pull up the income statement on Amazon, you can see why it's so impressive. You can see growth consistent over the last 5 years. 2018, they grew 300%, 17%, 83%, and then 56%. If we also look at that total revenue, we can see that it's growing consistently 20 to 30% every year for the last 5 years, and I think they will continue to grow as well for the coming years. We also see the balance sheet. The liabilities are catching up to the assets a little bit. They don't have the best balance sheet in the world, but something like Amazon has low risk of going out of business, so the balance sheet isn't too important to look at compared to the growth and the profitability of something like Amazon. So overall, I think before the split is a great place to buy, and honestly, under $3,000 is a great place to dollar cost average in. Dollar cost averaging into Amazon is probably the best strategy for the long term. However, bigger buys under $2,000 per share could prove very beneficial. Amazon's definitely a company I want to be a part of for the next few years. And I'm being patient. That's why I'm dollar cost averaging in, because I think that we can get it under $2,200 per share once again. However, there is no guarantees because Amazon could possibly rally due to the stock split. Next quick update we're going to do is Apple, because everyone always wants me to talk about them, and I love talking about them too. So let's talk about them. So Apple right at under 135 to 115, I think, is a prime loading zone. We had 137, Apple knocking on 137. So if it breaks that support and goes to that 135, then we'll have a possibility to see Apple at 125. And I think the red is not over yet. I think we still have some more red to see, especially with some big stocks like Apple and the S&P 500. But for some of those growth stocks that have already been slammed down 90%, 80%, they probably won't go down much further. But something like Apple, that's not even at a 52-week low, or something like Tesla, I think that a 52-week low is definitely a huge possibility for those stocks like Apple and Tesla. We'll dive into Tesla in future videos, so make sure you're subscribed with post notifications on so you don't miss any Tesla updates, because I try to talk about them at least once or twice a week because everybody loves them. So what are some price targets on Apple in the next 12 months? We have $186 as our price target, which is a 23% upside. And in my personal opinion, I think Apple's good for around 20% to 30% on the high end per year, consistently per year for growth in the stock price. Okay, if we scroll down, we can also see these were all reiterated fairly recently, and you can see that there are by good analysts too. JPM Morgan, Morgan Stanley, around $195 per share. So in my opinion, I think Apple is a great one to dollar cost average into under $150 per share for long term. I think it'll definitely be above $175 per share, and I think it'll be at new all-time highs in the next 12 to 24 months. So if you have a Roth IRA or 401k, Amazon and Apple could be awesome stocks to put in your Roth IRA or 401k, especially when Amazon splits, because then you can get a lot more shares to stuff into your retirement accounts once Amazon splits for long-term holding. We also see the average volume on Apple is way up, 100 million. So a lot of people are exchanging the shares more than normal right now. The market cap is 2.4 trillion, which is absolutely out of this world. It was at 3 trillion at its all-time high, and the PE ratio is only 24, implying that it is still a good deal even at $151 per share. And the last FANG stock that we'll talk about today, which is Netflix, is up 6.3% at close on Thursday. And we see them down 46% in the last 3 months. So this one, out of all the FANG stocks, is still down the heaviest, still down around 70% from highs. And this 70% fall happened in the span of around 6 months, which is absolutely disastrous for any company, but especially for a FANG stock company with a huge market cap. You know, Netflix was sitting at $500, around $500 per share for an extremely long time, and it was even up to around $700 per share at its peak. Right now, they are a profitable company. If we scroll down, we can see the EPS is actually trading around $3 EPS, which is really good, actually. Okay, and the market cap is 91 billion, which is fairly small for a FANG stock or FANG company. And we also have a PE ratio of 17, implying that it's actually a value stock right now and a steal in the stock market. So let's dive a little bit deeper. Now, if we pull up Netflix 5-year chart on their net income, it's actually more impressive than Amazon's net income when it comes to growth. Growing from 2017, 200%, 85%, 47%, 53%, 81%. So they pretty much, on average, do around 50 to 70% growth on their net income every single year for the last 5 years, which is a very attractive company. Now, obviously, they're losing their growth rate of new users, so that growth probably won't be as exponential in years to come, and that's why the stock price is falling. But if we also look at total revenue, it's been growing by around 20% consistently every single year. So that's an A+ net income, A+ on total revenue. The balance sheet is looking more like a D, okay, because it has 64% assets to liabilities. But again, something like Netflix has very low risk of going out of business. And if we look at the quarter-over-quarter growth, which is like Q1, Q2, Q3, Q4, Q1 2022, here we have the graph pulled up for their income statement. This is basically why their stock price is down, and it really only took a big hit in Q4. We had negative 22% growth and then negative 6% growth quarter over quarter. So short term, the stock market loves to look at quarter over quarter results, and if the quarter over quarter, if you have one off quarter, especially if you're a FANG stock, it could hurt the company or the stock price significantly. Personally, I like to look at year over year because it gives you more of the big picture and I'm a lot more, mostly a long-term investor anyway. So as of right now, Netflix could be a great deal in the stock market, even if it hits only $290 per share. That's still a 40% upside from the current price of $205 per share. So in the next 12 months, analysts agree that it'll be around $300 per share, which would be a nice little growth from current prices. You can see where these analysts are coming from. They just reiterated just a few days ago. We have 261 price targets, 265 hold price targets, $300 price targets. So personally, I'm dollar cost averaging into anything under $250 per share, and I'm buying fairly heavy on anything close to $200 per share or under $200 per share, but I'm mainly holding for long term because I think Netflix will continue to be the streaming giant that everyone knows in the next 2, 3, 5 years. It'll also move into the gaming industry by then. Personally, I really don't think Netflix is going anywhere, but Netflix is not one that you want to just hold for just a few months and then give up on them. You really want to believe in Netflix if you're going to be investing with them. And I think there's a strong possibility that we'll be able to sell at $300 per share, which would be around a 40 to 50% gain or return on your investment. But most of the stock I'm going to be holding for at least 100% gain, which would be around $400 per share. And that could take 24 months or longer. And if we want to read a quick summary, we see seeing as Netflix passwords are being shared with over 100 million households, subscriber growth is challenging. The $17 billion content spend for 2021 isn't expected to stop Netflix from losing subscribers for the first half of 2022. My thesis is that Netflix faces unpleasant questions as they expected to have fewer subscribers by the end of June than they did 6 months earlier at the end of December, going down from 221 million subs at the end of December to 221.6 million at the end of March was a painful loss of 700,000 subscribers in Russia helped Assad concerns. Netflix has bigger problems as they are anticipating the loss of 2 million subscribers in a Q2 2022. They expect to have only 219 million subs at the end of June compared to 221.8 million at the end of December. So that's why I think dollar cost averaging in is the best, or even waiting till the next earnings, because they could probably have at least 1 or 2 more bad earning seasons before they start flipping around. Seeing as Netflix has 74.6 million subscribers in the US and Canada regions, one could argue that means pretty much anyone who wants to watch Netflix in that region is already doing so. Netflix might be able to increase its revenue, but the number of people willing to pay a premium without ads in this segment is arguably near the limit already. Of course, there's a substantial amount of password sharing in all markets. Netflix estimates that 100 million household users share passwords globally. Some of these viewers will be able to monetize with ads, but increasing the number of premium paid subs will be more difficult than management led us to believe in the past. So I hope you guys enjoyed that video. Leave a big thumbs up on this video if you did. Make sure you share with a friend if you think that they can find this helpful. Subscribe with post notifications on so you don't miss any future banger videos. We're going to be talking about Tesla in future upcoming videos and a lot of other stocks like Roblox and much, much more. So I'll see you guys in the next video. Remember, don't time the market, buy the market. Peace.